Welcome once more to FT Headquarters. My name is Yuri, Editor of Professional Wealth Management. Our subject today is sub-advisory business, where banks, fund houses and insurance companies increasingly outsource selected asset management strategies to third parties. This is happening for a variety of reasons, including regulation, fee pressure and client demand for broader numbers of products. In order to explore this area further and the drivers behind an expected boom in sub-advisory business, I have with me today Robert Noach, Global Head of Relationships with Financial Institutions at blue-blooded London-based investment manager Schroders. Hello, Robert.
Hi, Yuri.
Robert, if I can ask you, firstly, it seems that Schroders, along with some competitor fund management groups, all big names, PIMCO, Templeton, Goldman Sachs, you're beefing up your offer in the sub-advisory sector. Now, sub-advisory business has been expected to take off for the last 7 or 8 years, but it appears that it perhaps may have stayed fairly constant, with only a handful of institutions choosing this route to broaden their range of strategies. Why do you think this area is now, at long last, likely to take off?
I think there are a number of factors at play here, Yuri. But one thing I would say is, although at the macro level, maybe the market has been fairly constant, from a Schroders perspective, our book of business has actually grown over the last 4 or 5 years. So I think part of the specialization in this market is the answer, i.e. it's not a market that every fund manager can enter. It involves a different set of servicing skills, a different set of fund management skills, and a different set of business development skills. So Schroders has focused on that, and yes, you're quite right, we're looking to focus even more in the years ahead because we do see it as a growth area.
And why do you expect it to take off? Why now? What is the confluence of factors that you're expecting to drive this business?
Okay, I think there are a few factors. Some of them have been around for a while, some of them are relatively new. So those that have been around for a while are factors like core competencies. It's in a ever more sophisticated world, it's not necessarily good or easy to be good at everything. So more and more people realize that even where they have an in-house fund manager, that doesn't mean they can cover every asset class, which means there'll be some gaps in their offering. And when they have a gap, they need to fill that gap. So they can go to an external third-party provider to help fill that gap. And that gap-filling capability still remains today, but I think it will grow even further because I think regulatory pressure means that if you can't do something well, you shouldn't do it because you won't survive any form of regulatory scrutiny unless you do something well.
And this regulatory pressure, Robert, will this be one of the key drivers? We've got the RDR in the UK, we've got MiFID II in Europe. Is it a case that the institutions must now repackage the financial products from external managers such as yourselves because they can't pay retrocessions, they can't pay any inducements to these managers anymore to sell their products off the shelf, that they have to have a more a packaged product where which will be more profitable for them?
That certainly be one of the drivers, Yuri, because obviously the economics and the value chain of the investment management industry and of the wealth management industry have changed. They're changing radically in the UK with RDR coming, and they're going to change quite radically in Europe with MiFID coming. So the net effect of all of that is you can't have retrocessions or rebates driving the economics of the industry. You're going to have a different economic model. And in that, it will force people to consider how best to get the fund management services they look for at the most economic price that they can, and that way build their value proposition to the underlying investor without relying on just retrocession or funds.
So the kind of model that the likes of Deutsche Bank and Commerzbank introduced in 2004, the so-called guided architecture where they'd have 8 to 10 fund managers and they would just really sell their funds off the shelf to their private clients. Is that a thing of the past now that we're going to move to the package solution?
I think that's going to differ a little bit whether you're talking about the advisory market and the discretionary market. I do think overall there is a trend away from that model, but I don't think it's a question of one will replace the other. I just think it's the relative balance between the different models will change. So I do think the days of guided architecture are going to actually improve, because the days of the open architecture models, where you can offer thousands of funds from hundreds of fund managers, is a very hard model to sustain in a highly regulated, cost-conscious world. So I do think there will be one pressure moving towards a guided architecture model. Having said that, even in a guided architecture model, not necessarily all the fund managers were getting, if you like, an equal share of the cake, and therefore it will move to a model whereby there will be winners and losers, if you like, in any form of change that comes to our industry.
So our research, Robert, appears to show that private banks and wealth managers in Europe will increasingly choose to establish partnerships with a smaller number of selected asset managers.
Yes.
Do we end up in a scenario where the private clients are just getting less and less choice, that they had a broader palette of strategies to choose from? Now there'll be a golden circle of 5 or 6 asset managers, whether you like it or not, that's the only choice you have. Schroders, PIMCO, Templeton, a couple of others, that's it.
I would like to think you'd be right, Yuri, but I don't think it'll be quite as simple as that. The first thing I would say is, even though in an open architecture world the theory was customers and advisors had very wide levels of choice, the reality was there were a certain narrow group of fund managers or fund houses or products that gathered the majority of the assets. So in reality, despite very wide-ranging choice, the 80-20 rule applied. 80% of the assets went to 20% of the fund managers or 20% of the funds. Going forward, I think the choice will be between maybe a more limited group, but they'll be better researched, they'll be better analysed. The comfort given to the underlying advisor or underlying investor will be such that they should have more confidence that the solution that they're getting is fit for purpose, is properly managed, will be risk controlled, and will deliver the results over time. And at the end of the day, I think that's the ultimate criterion, is does the customer get, or the client get, what they expect out of a product? And I do think by working with a core group of specialists, you're more likely to get that result. But that doesn't mean they all have to be the large players like PIMCO, Schroders, etc., who you've referred to. I do think there will still be a case for some specialist boutiques to gain traction in their particular specialist asset classes as well. So I think there'll be a combination of, yes, a core group of major asset managers who will be winners, but I also think there'll be some very specialist boutiques in certain asset classes who will be able to make their mark as well.
And Robert, you're holding regular conversations with Europe's biggest banks, insurance companies, fund houses.
Correct.
In terms of where they see the flows going. Are you expecting a resurgence in European equities in particular?
Well, once again, I hope you're right with that question, because Schroders is particularly strong in the European equity markets. And by any conventional series of evaluation measures, European equities at the moment are the most undervalued equities globally. So from that point of view, the greatest upside, if markets can normalize in Europe, is European equities. So it's hard to predict exactly which way the macro issues in Europe will play out with regard to the European Union, the single currency, etc. But if there's any degree of positive result, there should be a big flow of assets into European equities, and obviously Schroders, with others, will be big beneficiaries of that.
So private banks should be saying to their private clients, now is the right time to invest in Europe?
Well, we do believe that there is an opportunity, but we're not necessarily saying that it's a short-term opportunity, because, as I say, there are some macro issues which could delay or get in the way of that value being realized. But if you take a medium to long-term view, a 3 to 5 to 7 year view of European equities, we do think that there's a very compelling case for European equities.
Robert Noach of Schroders, thank you very much.
Thank you.